Welcome to the deep dive, where we really try to pull out the core insights from some fascinating sources.
That's the goal.
And today we're diving into a real giant, a cornerstone of economic thought, Adam Smith's The Wealth of Nations.
It's absolutely foundational, isn't it? And look, it's a huge book.
Yeah.
Our aim here is to maybe distill some of its most powerful early ideas for you.
Yeah, without getting totally bogged down.
Exactly. We won't cover everything, obviously, but we'll focus on those initial concepts.
Right. Think of it as a shortcut to understanding some really enduring principles.
Mhm.
We'll be looking at how Smith first explored things like, well, how just dividing up tasks, the division of labor, can create massive wealth.
And his early thoughts on what actually makes something valuable.
Yeah, and some observations about markets that feel surprisingly relevant even now. We're hunting for those key aha moments.
Mostly drawing from the early parts, the first books, will trace his thinking on the building blocks of economic activity.
Consider it a guided tour, maybe.
A guided exploration, yeah, through some seriously influential economic thinking.
Okay, let's unpack this. Starting with that idea that seems almost too simple, the division of labor.
It does sound straightforward, but its impact, according to Smith, is just profound. He doesn't start with abstract theory either.
No.
No, he uses a really tangible example. I think it's a boy working in a factory.
Oh, right.
Yeah, who's just trying to make his own job a bit easier, save himself some effort, and he accidentally figures out a way to improve the machinery.
That's brilliant. Innovation just bubbling up from, well, laziness almost. Or maybe self-interest.
A bit of enlightened self-interest, perhaps.
Yeah.
And Smith points out it wasn't just the workers using the tools who were driving these improvements.
Who else then?
Well, first, the people who actually made the machines. They
Okay.
specialized, right? So they got incredibly good at spotting ways to make them better.
Makes sense. Focus leads to expertise.
Exactly. And then, interestingly, he talks about philosophers or men of speculation.
Okay, what does he mean by that?
These are the thinkers, the observers. People who aren't, stuck in the weeds of one particular job. They can see the bigger picture, connect ideas from different fields.
Kind of like cross-disciplinary thinking today.
Precisely. Because they have that distance, they can combine knowledge in new ways. And he saw this specialization happening even within knowledge itself.
How so?
Just like a factory gets more productive by dividing tasks, Smith argued our understanding deepens when philosophy, or knowledge generally, branches out.
So specializing in different fields of study.
Yeah. Each expert digs deeper into their own area, and the sum total of knowledge grows faster.
It's striking how he saw it all as connected manufacturing, innovation, even philosophy. And this whole ability to specialize, it really hangs on one thing, doesn't it? Being able to trade.
That's the absolute linchpin. Smith says knowing you can exchange your surplus, whatever extra you produce, for the things other people make. Well, that's the engine. That's what motivates individuals to focus, to hone their specific skills.
Right. It's the move away from everyone having to do everything just to survive. Like in what he calls the nothing of savages.
Yes, moving beyond that basic subsistence level.
Mm?
Why spend ages trying to make, say, terrible shoes if you're good at growing food?
You just trade your extra food for good shoes from a specialist shoemaker.
Exactly. But, and this is key, this deep specialization isn't possible everywhere.
It depends on the market size, right?
Directly tied to it. Smith points out, in really sparsely populated areas, there just isn't enough demand.
So people have to be generalists.
By necessity. He gives the example of a country carpenter. They can't just be a carpenter, they have to be a joiner, a cabinet maker, maybe even carve things, make wheels.
Wow, a jack of all trades.
And the village smith has to do all sorts of different ironwork, not just one specific thing.
And that famous example of the nail maker.
In the remote Scottish Highlands, yeah. It perfectly illustrates the point. You could be the best nail maker in the world, churning out thousands.
But if there's no one nearby to buy them, or not enough people,
it's pointless. Your market is too small to support that level of specialization.
which leads us right into the next critical piece he identified.
The importance of markets, yes. And crucially, transportation.
How do those link up so tightly?
Well, Smith looked at history. He saw that the earliest, biggest improvements in crafts and industry didn't happen randomly. They happened where there was easy access to water transport.
Rivers and coasts.
Exactly. Waterways were the highways of the time. They opened up access to much wider markets, far beyond the immediate local area.
Which then allowed for more specialization.
And more trade, more wealth creation. It created a virtuous cycle. Moving goods by water was just so much cheaper and easier than hauling them over land back then.
Yeah, you can imagine.
So inland areas, cut off from these easy routes,
Mm-hmm.
they developed much more slowly.
Their markets were just smaller.
Limited.
Limited.
Limited to their immediate surroundings. Their economic progress was tied directly to the wealth and population right there.
He even used the American colonies as an example, didn't he?
He did. He pointed out how the early settlements clung to the coastlines and the banks of navigable rivers.
Following the transport routes.
It's clear evidence of how vital that access to wider markets was for getting things going economically.
Okay, so trade starts, specialization happens. How did Smith then start thinking about value itself? What makes something worth something? This is where labor comes in, isn't it?
Yes, this is fundamental. Smith proposed that ultimately, the real measure of the value you can exchange something for is labor.
Labor, not money.
Not primarily, no. His reasoning was this. For the person doing the work, the toil and trouble, the effort, that's constant. Whether you get paid a lot or a little in goods for an hour's work, that hour still costs you the same amount of your life, your effort, your ease and liberty, as he put it.
So the personal cost of the labor is the real benchmark.
That's the idea. The value of goods then fluctuates depending on how much labor they command or how much labor is needed to get them.
So if something takes a ton of work to make or find,
It's valuable. It's dear. If it's easy to get with little work.
it's cheap.
Right. Because labor itself has this kind of intrinsic, constant value to the laborer. It acts as a baseline for comparing everything else. He makes a really important distinction here
Which is?
between the real price, the labor, and the nominal price.
Which is just the price in money.
Exactly. Money is just the convenient way we express that underlying labor value in day-to-day transactions.
And the type of money used evolved too?
Oh, definitely. He observed societies naturally started using different metals, copper for small stuff, silver for everyday trade, gold for big purchases.
Hmm.
It was practical.
But one metal usually became the main standard.
Typically, yeah. Often the one they started using first just became the accepted measure, the standard against which other things, including the other metals, were valued.
Okay, moving from individual items, how did he see the bigger picture of price and revenue in an economy?
He broke down the price of pretty much any commodity into three basic parts:
Which are
wages, profit, and rent.
wages for labor, profit for capital,
Right. The return on the stock or capital investment.
and rent for the land used.
Exactly. And he argued that the entire annual output of a country, everything produced, is ultimately distributed among the people as one of these three forms of revenue.
Wages, profit, rent, those are the original sources of all income.
That's his argument. Trace any income back far enough, he says, and it comes from one or a combination of these. He uses a neat example to illustrate how they can sometimes get mixed up.
The farmer.
The common farmer, yeah. Often the farmer is doing the physical work,
So earning wages.
but they're also managing the farm,
Sure.
using their own stock, their own capital.
So earning profit, too.
Exactly. In that case, wages and profit are sort of confounded, as he puts it, in one person's income.
But in more developed economies.
In what he called civilized countries, rent and profit become much bigger slices of the pie, much more significant parts of the overall exchangeable value of goods. Meaning, the total output from a year's labor can actually command more labor in exchange than was directly used to produce it.
Because you've got the added value from land and capital contributing.
Precisely. But he adds a crucial caveat.
Which is?
Not all of this value created goes back to supporting productive activity.
Right.
He talks about the idle.
People who don't work or don't produce things.
Essentially, yeah. Individuals who consume part of the annual produce but don't directly contribute to creating new value. The balance between the industrious and the idle in a society really affects whether overall wealth grows, shrinks, or stays the same.
Right, that makes sense. Now, we know supply and demand aren't always perfectly matched in the real world. This leads to his distinction between market price and, what did he call it, natural price.
Natural price, exactly. The natural price is basically the minimum sustainable price. It's just enough to cover the ordinary costs of production, the usual rates of wages, profit, and rent needed to bring something to market.
Okay, the baseline cost.
Yeah. The market price, though, is what things actually sell for day to day, and that fluctuates.
Around the natural price.
Fluctuates around it, yeah. Driven by the short-term ups and downs of supply and what Smith called effectual demand.
Effectual demand, meaning?
Not just wanting something, but having the ability and willingness to actually pay the natural price for it.
Got it. And he noticed some prices swing more wildly than others.
Definitely. Think about agriculture. Output is super variable, right? Depends on the weather, harvests,
So farm prices can jump around a lot.
huge volatility sometimes. Compare that to, say, making linen or woolen cloth. Production there is much more predictable, more stable.
So their prices are steadier.
Generally, yes. Manufactured goods prices tend to move more based on shifts in demand, while agricultural prices get hit by both demand and those unpredictable supply swings.
Okay, let's shift to the labor market itself. Smith saw workers starting to organize even back then, didn't he?
He did, yeah. He describes workmen getting together, forming combinations to try and push for higher wages,
What reasons did they give?
often citing things like the high cost of food and necessities, or pointing to the big profits their employers, the masters, were making. Smith noted these combinations were often quite public and sometimes turbulent.
And the employers? They pushed back?
Oh, absolutely. The masters often combined too, usually more quietly, and they'd frequently call on the magistrates, the legal authorities, to crack down on the worker combinations.
Using the law against them.
Yes, the laws at the time were generally stacked against worker combinations. Smith observed that these efforts by workers rarely succeeded for long.
Why not?
Several reasons. The intervention of the law, the fact that masters usually had more financial resources to withstand a dispute,
They could afford to wait it out longer.
and critically, the workers often just needed to earn money now for basic survival. They couldn't hold out for extended periods.
It really shows that power imbalance in the early days of industry. What about wages and the cost of living more broadly? Did he look at historical trends?
He did. He compared wages and the price of grain in Scotland and England in his time, the 18th century, with the previous century, the 17th.
And what did he find?
A general trend where the money price of labor, the nominal wage, tended to go up over time.
So people were earning more pounds or shillings?
Yes. And interestingly, this sometimes happened even when the real price of essentials, like grain, might have actually been falling.
So their money wages went up, and that money could potentially buy more food.
Potentially, yes. The real wage could increase.
Yeah.
He also noted how short-term demand changes affected wages.
Like in good years.
Exactly. When the economy was booming or harvests were plentiful, employers had more money to invest and needed more workers.
But the number of workers doesn't instantly increase.
Right. So employers would have to compete for the available labor, bidding up wages, both in money terms and potentially in real purchasing power, at least temporarily.
Now, how does profit fit into this mix with wages and prices?
Smith had an interesting take. He argued that in wealthy countries where there's a lot of capital already accumulated, the rate of profit on that capital tends to be lower. But that lower profit rate can actually help offset higher wages when it comes to the final price of goods.
How does that work? Lower profit helps pay for higher wages.
In a sense, it allows those richer countries to still sell their goods competitively, even against neighbors where wages might be much lower, but profit rates are higher. Efficiency and the sheer amount of capital make up for the higher labor cost.
That's a bit counterintuitive, but he also said high profits push up prices more than high wages do.
Yes, that's a crucial point. He used linen manufacturing as an example. Think about the production chain.
Okay.
If wages go up, that adds to the cost at each step in a fairly straightforward additive way, like arithmetic.
A plus B plus C.
Sort of. But if the profit margin demanded by each employer in the chain goes up,
The weaver, the spinner, the merchant.
right, that increase gets compounded at each stage. It's more like multiplication, a geometric effect.
Yeah.
So high profit rates tend to inflate the final price much more significantly than high wages do.
Okay, that makes sense. Let's think about why wages differ between jobs. Smith saw several reasons, right?
He did. Some are pretty intuitive. Jobs that are disagreeable, really tough physically, or dangerous.
Like coal mining.
Coal mining, yeah, or coal heaving, which sounds incredibly strenuous. Those jobs often paid more. It was compensation for the downsides.
Hazard pay, essentially.
And also, jobs where employment was irregular, like that coal heaving again. You might have work one day, none the next. The higher wage had to cover those periods of uncertainty and inactivity.
So a premium for instability, too. But he thought competition would level things out, generally.
To a degree, yes. If a job paid way too much compared to its difficulty or unpleasantness, and there weren't any artificial barriers like guild rules.
Like the apprenticeship rules.
Right. If anyone could learn to do it, then more people would flock to that job, attracted by the high pay.
Supply of workers goes up.
And the wage would naturally come back down to a more balanced level. competition regulates it.
Risk is another big factor, especially for profits, isn't it?
Hugely important. Smith looked at really risky ventures, like smuggling,
High risk, high reward.
potentially very high reward if you succeeded,
Well,
but also a very high chance of failure, getting caught, losing everything, bankruptcy. He actually argued that the intense competition within those risky trades often drove the average profit down below what you'd strictly need to compensate for the danger involved.
interesting. So overall, did he think profit rates varied as much as wages?
No, generally less so. He observed that while wages could swing quite a bit based on agreeableness, difficulty, risk, profit rates tended to find a more common level across different industries,
Why is that?
mostly because capital's more mobile. You can shift your money from one investment to another relatively easily.
Easier than a worker retraining for a completely different job.
Exactly. Labor isn't as fluid as capital, so wage differences tend to be more persistent than profit rate differences across different employments of stock.
Okay, so those are kind of the natural reasons for differences. But then Smith really digs into how government policies create artificial inequalities. This is where he starts critiquing intervention, right?
Absolutely. This is core Smith. He argued that a lot of European policies at the time actively messed with what he saw as the natural order, the system of natural liberty.
How did they do that?
Mainly in three ways, he said. First, by restricting competition in some areas. Second, by artificially increasing competition in others. And third, by blocking the free movement of labor and capital between different jobs and places.
And the statute of apprenticeship was a prime example of restricting competition.
Yes. He thought it was full of illogical restrictions, like limiting it only to trades that existed before a certain date in the 1500s.
Leading to absurd situations.
Totally. His famous example. A coachmaker wasn't legally allowed to make his own wheels, even though that's part of making a coach, but a wheelwright could make entire coaches. It made no sense.
And these rules help too. The established trades, the guilds.
Exactly. They protected the insiders, the existing corporations, by limiting who could enter the trade,
Keeping supply down and prices up.
at the expense of the public, who had to pay more. He also pointed out that getting permission to form these trade corporations often involved jumping through hoops with town authorities, sometimes even needing a royal charter,
Often costing money, creating a barrier.
creating local monopolies, essentially.
And these town-based rules often hurt people in the countryside.
Smith argued they did. By favoring town-based manufacturers and traders, these regulations skewed the whole economy. Landlords, farmers, rural laborers were put at a disadvantage in the distribution of the nation's output.
He even pushes back against the idea that country folk were less sharp.
He does. He suggests their understanding might actually be broader because they dealt with a wider variety of things, unlike the narrow specialist in town,
And he pointed to other places, like China or India.
where he believed agricultural workers were sometimes held in higher regard and better paid than many artisans, precisely because there weren't these restrictive town corporations messing things up.
It really shows his faith in the natural economic flow when left alone. He then uses another example, men of letters.
Yes, educated people, often trained for the church, but finding there weren't enough positions.
An oversupply of educated workers.
Exactly, which drove down their wages, their compensation. He warned that the same could happen to prestigious professions like law or medicine if they became overcrowded.
It's a very early insight into supply and demand in skilled labor markets. Then he tackles restrictions on people moving around the poor laws in England.
Right. These laws made it really difficult for poor people to move from one parish, one local area to another to find work.
How did they work?
You essentially needed to prove you wouldn't become a burden on the new parish, often by renting property above a certain value or getting someone to guarantee you financially.
So it tied poor laborers to their home parish.
Largely, yes. It severely hindered labor mobility, preventing people from going where the jobs and better opportunities might be. He also noted how complex and prone to disputes and even fraud these laws became.
Okay, let's talk about land. Smith saw rent as a special kind of price, didn't he? A monopoly price.
He did. He emphasized it wasn't set based on what the landlord put into the land or what they needed to live on. It was simply the highest price a farmer could afford to pay, given the demand for what the land could produce.
Determined by the market for the produce, not the cost of the land itself.
Exactly. And only land that could produce something valuable enough to cover all the farmer's costs, wages, tools, fertilizer, plus a normal profit for the farmer, could actually generate any rent for the landlord.
The land had to be productive enough first? He also discussed how land gets used differently.
Yeah, he talked about things like enclosing land with fences. Historically, maybe a simple kitchen garden didn't justify the expense of a fence.
But more valuable crops might.
Right. Or cultivating finer fruits that needed protective walls that only made sense in climates where they'd actually grow well and fetch a good price. He also noted an interesting relationship between common crops and specialized ones.
Right.
The rent and profit you could get from, say, growing grapes for wine was often sort of regulated by the rent and profit you could get from just growing ordinary corn or using the land for pasture.
Unless the demand for the specialized thing, like wine, was super high.
Exactly. If demand wildly outstrips supply for the specialty item, then its price, rent, and profit could detach from the baseline set by common crops.
What about mining? That seems different from farming.
It has its own economics, for sure.
Hmm.
Smith explained how the most fertile mines in an area often set the price for minerals.
Because they could produce more cheaply.
Yes, they could afford to sell their output for less, underselling competitors, while still making good rent for the owner and good profit for the operator.
Squeezing out the less efficient mines.
Potentially, yeah. He contrasted Cornish tin mines, where rent was a high proportion of the final price, with silver mines in Peru.
What was different there?
The Spanish government took a huge chunk in taxes, which dramatically affected profitability and, according to Smith, created massive incentives for smuggling to avoid the tax.
Right. Let's switch back to broader price trends. He looked at historical prices of wheat and silver.
He did. He mentioned things like the old assize of bread and ale, which were attempts to regulate bread prices based on wheat prices. He also cautioned about interpreting historical price records accurately. Data wasn't always great.
And the impact of American silver.
Huge impact. All that silver flowing into Europe after the conquest significantly decreased the value of silver relative to basic goods like corn, at least initially. Silver became less scarce, so its purchasing power dropped.
But when he looked at wages rising in 18th century Britain, he didn't think it was just because silver was worth less.
No, he argued it was more likely due to a real increase in demand for labor. The economy was growing, thriving, needing more workers.
So wages were pulled up by genuine economic expansion, not just pushed up by inflation.
That was his interpretation, yes, a sign of prosperity. He also looked at cattle prices.
How did they fit in?
As economies improved and more land was cultivated for crops, pillage, the land available for grazing cattle might shrink, while demand for meat often rose with prosperity.
So cattle prices would go up?
They tend to rise, yes, until it became roughly as profitable for a farmer to use land to grow feed for cattle as it was to grow crops directly for humans. At that point, the price would tend to stabilize relative to grain. He noted England reached this point earlier than Scotland.
Interesting. Did he see prices of different foods moving differently?
Yes, potentially in opposite directions. Agricultural improvements might make root vegetables, like potatoes, much cheaper to grow,
Lowering their real price.
while the real price of meat might be rising due to land use changes, so diets could shift. He also looked at manufactured goods, like cloth.
How did their costs change?
He pointed to old laws that used to regulate what kind of clothes laborers could wear. Comparing those times to his own, he argued the real price of even coarse cloth, meaning how much basic food like wheat you'd have to trade for it, had fallen significantly over time.
Even if the money price didn't change much.
Right. It indicated big improvements in manufacturing efficiency, or perhaps quality. And finally, on land, he ties it all together. Sustained improvement in farming directly boosts land rent,
Makes the land more valuable.
both in absolute terms, the amount of rent collected,
Right.
and often as a proportion of what the land produces. Improvement pays off for the landowner.
Okay, let's move on to capital and money again. This is really central to his whole system.
It is. And he makes a really interesting point about money itself. He says it's the only part of a country's circulating capital.
Meaning capital used in day-to-day transactions.
Yes. It's the only part whose maintenance actually reduces the net revenue of society. Because maintaining a stock of gold and silver coins ties up valuable resources that could otherwise be used productively. It's like the expense of building and maintaining machinery.
It's a necessary cost, but it's still a deduction from the potential total output.
Exactly. It facilitates trade, but the metal itself isn't directly producing anything new.
But he wasn't against using gold and silver for international trade.
No, not at all.
Yeah.
If you send gold abroad to buy foreign goods that people want or need, that's fine. The goods are the real gain.
And if you use that gold and silver to finance trade between other countries, the carrying trade.
Then the profits from that trade add directly to your nation's net revenue. It's a productive use of capital.
Mm-hmm.
But he was very wary of banks messing things up with paper money.
Over-issuing it.
Yes. If banks print way more paper notes than they have gold and silver to back them up, eventually those notes come flooding back to the bank, demanding redemption.
And the bank has to pay out its reserves.
Right, potentially leading to losses or even collapse. He mentions the Bank of England frequently having to get new gold coins minted because its paper was constantly being returned for exchange. He also discusses historical banking crises,
Caused by bad practices.
often by banks lending excessively, maybe funding speculative ventures, or projects with very slow returns, like that Scottish bank trying to fund long-term land improvements. A poor understanding of basic principles. He also stressed the weakness of a purely paper currency system.
Vulnerable in crises.
Very. In wartime, or if there's a major panic, confidence can evaporate. Physical gold and silver feel much safer then. He also disliked very small denomination paper notes issued by potentially shaky, beggarly bankers.
What about that Bank of Amsterdam, Agio? That premium on its money?
He discusses the common explanation that the bank kept supply tight, but later dismisses it as probably chimerical, basically a myth or misunderstanding. His core belief remained firm.
That the value of gold and silver depends on mining.
Yes, on the real cost, the labor required to get them out of the ground, not on local paper currency games. Ultimately, he favored free banking.
Let banks compete.
Yes, but with crucial safety rules. No tiny notes, and banks must pay out gold or silver immediately on demand. He thought competition under those rules would make the system safer overall.
Okay, what about interest rates? How did they fit into his picture of capital accumulation?
He saw a clear historical pattern. In less developed economies with smaller amounts of total capital, interest rates tended to be much higher. Why? Because capital was scarce, and the potential profit margins on using it were often very large.
High demand for limited capital drives up the price. Interest.
Exactly. Conversely, in richer countries with lots of accumulated capital, there's more competition among lenders.
Which pushes interest rates down.
Yes. The rate of profit per pound or dollar invested tends to fall.
Right.
But of course, the total amount of profit generated across the whole wealthy economy is vastly larger.
And how that capital gets used matters enormously, right? Invested versus just spent.
Critically important. He contrasts towns focused on trade and manufacturing, full of industrious people investing capital productively, with towns dominated by, say, a royal court,
Where money is spent on consumption, servants, luxury.
leading to more idleness and less overall wealth creation. Even if that extravagant spending happens domestically, he argued, it still harms the nation's productive funds by diverting resources away from investment.
So borrowing money should really be for investment, not just for spending.
That's his strong advice. Borrowing just to consume leads to ruin for the borrower and eventually the lender if it becomes widespread. He believed prudent people naturally prefer lending to the industrious, the producers, rather than the spendthrifts.
He even seemed to grasp a version of the money multiplier effect.
In an intuitive way, yes. He described how the same actual coins could facilitate numerous loans and purchases in quick succession. £100 could enable transactions worth many times that amount.
The real value is the activity it enables.
Right, the power to make those purchases and investments. He also discussed usury laws' limits on interest rates.
Why have them?
The traditional reason was to prevent extortion, preying on desperate borrowers. Smith acknowledged that, but argued the legal maximum rate should be set just a little above the lowest common market rate.
Why, just slightly above?
If it was set too low, say below the rate needed for moderately risky but still worthwhile projects, it would stifle lending. Only the safest borrowers would get loans. Setting it slightly higher allows lending to flow more freely to reasonably sound ventures, while still discouraging truly excessive rates.
Okay. He then categorizes how capital gets used in an economy.
Into four main areas. First, getting raw materials, farming, mining, fishing.
Okay.
Second, manufacturing or processing those raw materials.
Oh, making okay.
Third, transporting goods, either raw or finished, to where they're needed.
Logistics.
And fourth, retailing, dividing goods into smaller quantities for final consumers.
He's shopkeepers. And did he think some uses were better than others for the nation?
He did, in terms of supporting domestic labor and output. He argued capital used in the home trade, producing and selling goods within the country, generally supports more productive domestic workers and adds more to the national output.
More than foreign trade.
More than the foreign trade of consumption, importing goods for domestic use.
Yeah.
Which in turn was generally better than the carrying trade just transporting goods between other foreign countries,
Why the preference for domestic?
because it directly employed local labor and resources throughout the entire chain.
Mm.
He felt political economy shouldn't artificially favor foreign trade over domestic because national wealth ultimately depends on the annual domestic produce. This ties into his idea of the natural progress of opulence.
How things should develop, ideally.
Yes, he saw the most fundamental commerce as being between the town and the country.
Exchanging food and raw materials for manufactured goods.
Exactly, a mutually beneficial division of labor. Towns need the countryside's surplus food and materials to exist and grow.
Though that surplus could come from far away via trade.
True, but the principle holds. And he believed the natural inclination for investors, if things were left alone, was to put capital into improving land first.
Why land?
Greater security, more direct control, less risk compared to distant trade or complex manufacturing, at least initially. People prefer investing close to home where they can see and manage things. Unless, he said, bad institutions or policies get in the way.
Which he argued happened in Europe after the Roman Empire fell.
Yes. The resulting chaos disrupted that vital town-country trade, leading to agricultural decline. Land ended up concentrated in few hands, and various policies actively discouraged farming.
Like banning grain exports.
Prohibiting corn exports without special permission, restricting inland trade with anti-engrossing laws, giving towns special market privileges. All these things hindered agriculture in places like ancient Italy and later across Europe.
But towns eventually gained more freedom.
Generally, yes, they often managed to secure independence earlier than rural areas, sometimes by agreeing to pay a fixed tax sum directly to the king, bypassing local lords or officials.
Giving them more autonomy.
Or sometimes, whole manors were leased collectively to the tenants, freeing them from direct royal interference.
Highlighting again that link between town and country manufacturing grows out of agriculture.
He saw it that way. Basic survival limits town size initially. But once you have manufacturers, especially refined ones, with high value for their weight,
Like fine textiles or metalwork.
they can be transported long distances. This allows towns to grow much larger, drawing resources from far beyond their immediate hinterland. He saw places like Leeds and Birmingham as natural results of agricultural progress, creating demand and surplus.
And in England, policy eventually started helping agriculture more directly.
Yes, alongside the growth of commerce. England moved towards freer corn exports, even introduced export subsidies, bounties sometimes, and used import duties to protect its farmers, a contrast to earlier restrictions.
Then he tackles mercantilism head-on.
Yes, that whole system focused on piling up gold and silver by exporting more than you import, the favorable balance of trade.
An idea pushed by merchants.
Heavily influenced by merchants lobbying governments for policies that restricted imports, benefiting their own businesses. Smith acknowledged foreign trade made countries richer, but,
He thought the mercantilist explanation was wrong.
or at least self-serving and incomplete. Merchants understood their own profits, but not necessarily the true sources of national wealth, and their policy advice often confused the two.
He also connected trade to warfare, didn't he?
In an interesting way, he explained how a country rich in high-value manufactured goods could fund wars abroad without draining its gold reserves.
How?
The government could buy foreign currency from its own merchants, who had earned it by exporting goods, to pay troops overseas. The exports essentially paid for the war. He even noted war could sometimes boost demand for manufacturers, creating a strange kind of wartime prosperity.
And then a slump when peace returned. He defined drawbacks and bounties, too.
Just clarifying the terms. Drawbacks are refunds of import duties if goods are later re-exported. Bounties are direct government payments to encourage production or export of specific goods.
And he was generally against policies restricting imports to protect domestic industries.
Very much so. High duties or outright bans on imports might create domestic monopolies for local producers. He mentions British cattle farmers, corn growers, woolen manufacturers benefiting from this.
But he thought it was inefficient.
Yes. He famously argued that individuals pursuing their own interests are usually far better judges of where to invest their capital than any statesman or government planner could be. Trying to direct industry via protectionism is likely to misallocate resources.
What about the act of navigation, though? The law promoting British shipping.
He acknowledged its goal, strengthening the Navy for national defense, might make it wise from a security perspective, even if it harmed overall trade.
How did it harm trade?
By restricting foreigners from selling goods in Britain or carrying British goods, it also restricted their ability to buy British goods. It likely meant Brits paid more for imports and got less for exports than they would have with free competition in shipping, a potential trade-off between defense and opulence.
He also talked about retaliatory tariffs.
Yeah, how protectionism breeds more protectionism. If one country restricts your goods, you tend to retaliate by restricting theirs. He cited historical examples involving France, the Netherlands, and England.
Interestingly, he observed that sending soldiers home after wars didn't usually cause massive unemployment.
Surprisingly smooth reintegration, he noted. Large numbers of soldiers and sailors were absorbed back into the economy with relatively little disruption or major wage drops, except maybe temporarily for merchant seamen whose jobs were directly affected by wartime fluctuations.
Why was it so smooth?
He contrasted manufacturers who were used to working and could adapt skills with soldiers who might be more accustomed to idleness and relying on pay. Productive workers found ways back into the economy.
He revisited the Bank of Amsterdam again.
Focusing on the claimed benefits of its bank money over physical coins, security, ease of transfer, that premium IGO it commanded for settling foreign debts.
Because it was seen as reliable.
Yes, and the belief, which he later doubted, that the bank directors cleverly kept supply just below demand to maintain that premium. But again, he ultimately seemed skeptical of the traditional account.
And his overall view of merchants and manufacturers influencing policy remained pretty negative.
Scathing at times. He condemned their mean rapacity and monopolizing spirit, arguing they were fundamentally driven by self-interest, not the public good, and shouldn't be trusted to run the country or dictate policy.
His bottom line.
It's always in the public's interest to buy from whoever sells cheapest. Protectionist arguments were just self-serving sophistry from these groups.
He then introduces a different kind of balance to focus on.
Not the balance of trade, exports versus imports, but the balance between a nation's total annual production and its total annual consumption.
That's the real measure of economic health.
Yes. If production consistently exceeds consumption, the nation's capital grows, leading to more wealth. If consumption exceeds production, capital decays, and the country gets poorer. That's the balance that matters.
He used the wine trade to show how complex and maybe illogical trade rules could be.
A great example. British duties on French versus Portuguese wine, the impact of the Methuen Treaty favoring Portugal, the complex rules about drawbacks on re-exported wine. It illustrated how convoluted and sometimes counterproductive these regulations were.
And bounties. He wasn't a fan.
Saw them as generally inefficient. They forced trade into artificial channels, making the country produce or export something it wouldn't otherwise, meaning it's likely doing it less efficiently than alternatives.
So it's a waste of resources.
Essentially, yes. Bounty-supported exports cost the home consumer twice, once through taxes to pay the bounty, and again through potentially higher domestic prices if supply is diverted abroad.
What about trying to hoard gold and silver, like Spain and Portugal did?
He thought that was counterproductive too. It just made gold and silver artificially expensive within those countries, while potentially making them cheaper elsewhere, giving other trading nations an advantage.
Better to let metals flow freely?
Yes. They'd find their natural value everywhere, and any metal exported would ultimately pay for imported goods, potentially fueling more domestic industry. Hoarding didn't increase real wealth.
He had a specific critique of the herring fishery bounty.
A classic example of bad incentives. The bounty was paid based on the tonnage of the fishing boat, not the amount of fish caught.
So people built boats just to get the bounty.
Pretty much. It encouraged fitting out ships just to qualify for the payment, leading to incredibly high cost per barrel of actual herring caught. An absurd waste.
He also criticized rules about selling corn.
Laws that forced farmers to sell grain directly to consumers in small amounts, hindering the development of specialized grain merchants.
Why was that bad?
It distracted farmers from focusing on farming, made distribution less efficient, and potentially made corn scarcer and more expensive overall. A proper corn merchant trade, he argued, would help stabilize supply and support farmers better.
And England eventually moved away from those restrictions on corn.
Yes, he traced the gradual liberalization, allowing exports more freely, even paying bounties on exports in times of surpluses.
He saw restricting the corn trade as dangerous, especially regarding famine.
Absolutely. Preventing grain from moving freely from areas with surpluses to areas with shortages could turn a local scarcity into a devastating famine. While tiny states might need control sometimes, large countries like France or England rarely did, in his view.
And it was unjust to farmers.
Fundamentally unfair to stop them selling their produce in the best market, except maybe in the most extreme emergencies.
What was the deal with the Methuen Treaty again? Portugal and wine.
It guaranteed Portuguese wines lower import duties in Britain than French wines.
Why did Britain agree to that?
The context was Portugal getting loads of gold from Brazil, which it wasn't allowed to export directly but needed to use to buy goods. England became a major supplier of those goods, and the treaty ensured Portugal had a guaranteed market for its main export, wine, in Britain, facilitating the overall flow of trade and, indirectly, gold to England.
Complicated. What about coinage itself?
In countries like Britain, where the government minted coins basically for free, the value of a coin stayed very close to the value of the raw metal, bullion it contained, maybe a tiny premium for the convenience of it being a coin.
But worn coins were worth less.
Effectively, yes. If coins were underweight due to wear, they wouldn't buy as much, and the market price of bullion, raw metal, would appear to rise relative to the worn currency.
Shifting to the New World, the initial driver was gold and silver.
Massively so. Those early reports from Spanish America, often exaggerated, fueled the whole enterprise. Mexico and Peru initially delivered on those hopes spectacularly.
But other European countries tried colonizing too.
Yes, though often less successfully at first. He mentions a failed Swedish colony and Danish colonies run by an exclusive company. He generally saw these monopoly companies as harmful.
Like with the Danish islands.
St. Thomas and Santa Cruz only really prospered after the exclusive company controlling their trade was dissolved, allowing for freer commerce. Monopolies stifled growth.
And the British sugar colonies had complex rules too.
Very. Tiered import duties on different grades of sugar effectively stopped colonial producers from refining their own sugar for export, and even limited refining for the British market itself.
Giving British refiners a monopoly.
Pretty much. He contrasted this with French colonies, where sugar refining was allowed and apparently flourished more,
He also addressed slavery in those sugar colonies.
noting it was widespread due to the climate and labor demands. He mentioned debates about using better farming tech like the drill plow there. He also offered the view that French planters might have managed to enslave people more effectively, or at least less wastefully, than the English.
And a strange point about laws protecting slaves.
A rather counterintuitive observation that perhaps in colonies with more top-down arbitrary government power, laws protecting slaves, however minimal, might be enforced better than in colonies with freer institutions where local planter interests held more sway. A complex and grim point.
His overall verdict on European colonialism.
Pretty damning. He saw it driven largely by folly, the obsessive hunt for gold and silver, and injustice in how indigenous populations and resources were treated.
Though he acknowledged the colonists themselves were often enterprising.
Yes, succeeding despite, not because of the often misguided policies of their home governments. But Europe did gain from America, didn't it?
Oh, hugely. New goods, obviously sugar, tobacco, coffee, cotton, potatoes.
And perhaps more importantly, the discovery spurred a massive expansion of global trade. Even countries not directly trading with the Americas benefited,
How?
because the whole European market became bigger, richer, with more goods circulating. This stimulated industry and increased enjoyments across the board. It lifted the entire European economy.
But the exclusive trade with colonies, the mercantilist ideal.
Smith critiques this heavily. The argument was that the mother country gets colonial goods cheap and sells its own exports dear in this closed system.
But he thought high profit rates were actually bad overall.
Yes. Artificially high profits generated by colonial monopolies made a country less competitive in other trades. Its goods were too expensive, its imports cost too much. It led to less overall production and consumption than free trade would allow.
And the focus on colonial trade diverted capital.
Pulled capital away from potentially more productive trade with neighbors in Europe or direct trade further afield into these long, roundabout, less efficient colonial routes. It supported less domestic labor and made the economy more precarious, reliant on these distant, controlled markets.
He even floated the idea of letting the colonies go.
Quite radically for his time, yes. He suggested that granting independence could save Britain the huge cost of defending and administering them, and might lead to a friendly free trade relationship that would be more beneficial in the long run. Build alliances, not resentment.
What about taxing the colonies?
He foresaw the difficulties. Colonial assemblies struggled to raise enough money even for their own needs, let alone contributing significantly to the empire's costs. He drew parallels to the historical struggles the English Parliament had faced in establishing its own power to tax effectively.
And the East India companies, he saw them as monopolies too.
Monopolies directed not just against foreigners, but against their own countrymen. After Portugal's power faded, the Indian Ocean trade was largely carved up by these exclusive European companies.
Harming their home countries.
Yes, by shutting out independent merchants and driving up the price of East Indian goods through high profits and often inefficient management and corruption.
He also mentioned rules keeping English wool prices low.
Historical regulations designed to give English cloth manufacturers cheap raw materials, depressing prices for English sheep farmers compared to what their wool could fetch in open markets like Amsterdam. Another example of favoring one group over another.
Then comes his famous distinction: productive versus unproductive labor.
A really key concept for him, though controversial later. Productive labor, for Smith, is labor that creates a tangible, sellable commodity. Something that embodies value, lasts for some time, and can replace the cost of the labor plus generate a profit.
Like artisans, factory workers, merchants moving goods.
Yes, unproductive labor, in contrast, is service labor. Its results perish the moment the service is performed. Think menial servants, but also, controversially, professions like clergy, lawyers, doctors, performers, even the sovereign.
They consume value but don't create a lasting commodity.
That was his view. It doesn't mean they aren't useful or necessary, just that they don't directly add to the stock of physical vendable goods that constitute national wealth in his framework.
But trading and manufacturing nations still have an advantage.
Even if you just looked at basic subsistence, he argued, nations with trade and manufacturing would have greater total revenue than purely agricultural ones.
He also touched on military evolution.
Linking the rise of standing armies to economic development. As societies became more complex and manufacturing advanced, the old feudal militias became inadequate.
Especially with firearms.
Firearms made warfare more specialized and expensive, requiring trained, professional standing armies for defense against both civilized neighbors and barbarian societies. Feudal lords lost their military dominance.
And the cost of justice also increases.
As society develops, property becomes more significant, interactions more complex, so the need for and cost of a formal justice system grows. Hunter-gatherer societies have little property, hence little need for formal courts and laws compared to complex agricultural or commercial states.
Where does authority come from in society?
He identifies a few sources: personal qualities, strength, wisdom, age, and crucially, wealth or fortune. In societies with significant inequality, fortune becomes the dominant source of authority and social rank.
Like a Tartar chief leading through personal prowess versus a rich person in a civilized society.
Right. The rich person might not command directly in the same way, but their wealth grants influence and status. He then makes a provocative claim about government's purpose.
That it defends the rich from the poor.
Civil government, he says, so far as it is instituted for the security of property, is in reality instituted for the defense of the rich against the poor, or of those who have some property against those who have none at all. A stark view of its fundamental role in unequal societies.
How are rulers historically funded?
Initially, often from their own property, vast herds, extensive lands, plus occasional gifts or fees collected by their courts. Not regular taxation as we know it.
But that system was prone to abuse.
Very difficult to prevent rulers from exploiting these less formal revenue sources excessively.
What about funding public works like roads?
He uses turnpike tolls as an example. They show the principle of users paying for infrastructure. But he notes potential government inefficiency in managing them, while also worrying that overly high tolls could strangle internal trade. A tricky balance.
He also discussed different types of trading companies. Regulated companies.
Yes, like the old Hamburg or Turkey companies in Britain. These were associations of merchants trading in a specific area, with rules governing entry and conduct. But members traded on their own accounts.
And they declined.
Their monopoly powers were gradually weakened by Parliament, making it easier for outsiders to join the trade. They faded as freer trade became more common.
Contrasted with joint stock companies, like the East India Company,
where investors pool capital and share profits losses managed centrally. The English East India Company evolved into this powerful joint stock entity with an exclusive government charter. Hugely successful commercially, but also controversial for its monopoly and later, its political power. Smith notes growing doubts about the legality of such royal charters if not backed by Parliament.
Wow, that's an incredible sweep of ideas. Foundational is definitely the right word.
It really is a remarkable attempt to systematically understand how economies work, how wealth is generated, and how policy affects it all. Still so much to chew on there.
So just to wrap up this deep dive, let's quickly recap the big themes. We started with the sheer power of the division of labor,
How specialization unlocks productivity.
then the vital role of markets and transport in enabling that specialization and growth.
And Smith's early, really fundamental ideas about value and price being rooted in labor.
Yeah, and his sharp critiques of how government intervention through things like monopolies, regulations, and misguided trade policies often distorted markets and actually hindered the creation of wealth.
These excerpts really give you a glimpse into the thinking that launched modern economics. The frameworks he built are still debated and used today.
Absolutely. So maybe the final thought for you, the listener, is this. How do these observations from over 2 centuries ago resonate now?
Or where do they differ from our world?
Right. Think about today's global supply chains. Isn't that just the division of labor on a planetary scale? What's the modern equivalent of water transport? Maybe the internet, global logistics.
And the debates about government intervention versus free markets are obviously still very much alive. Are the issues fundamentally the same ones Smith grappled with?
The Wealth of Nations is definitely a historical text, but the questions it raises, the frameworks it offers, they provide powerful tools for understanding the economic forces shaping our own society.
It really encourages you to look at the world around you through that economic lens he developed, an enduring legacy.